everyone, and welcome to today's webinar. My name is Karen Appleton. I'm Head of Lending at Skipton Building Society with a background of over 20 years in financial services, including time and credit risk, and I now head up the Underwriting department. Aidan Walker and myself are presenting today. We are hoping to give you an insight into the credit risk, data view, and the underwriting, real-world view, and how we work together. We'll help you to understand how scoring works and how to connect the dots between automation and flexibility where data doesn't necessarily tell the full story. We'll cover topics such as how to make a borderline case not borderline, helping you identify when it's worth sharing additional information to get the right case through. We'll also look at the importance of properly packaging a case before pressing send and what tools are available to support you placing a case. Over to you, Aidan.
Thank you, Karen. I'm Aidan Walker from the credit risk team. Throughout my time with Skipton, I've worked closely with the underwriting team, balancing making sound risk decisions while making things easier for you, in particular when considering affordability model and scorecard implementations. As you'll know, affordability score and lending policy are the main components in a mortgage lending decision. All three of these must be acceptable for an application to be offered. It's balance the risk to the lender with responsible lending, making sure it's affordable for the customer. This means a low LTV and no loss for the lender is no justification for an affordable lending. All major lenders perform a credit search from at least one of the credit reference agencies, such as Experian, TransUnion and Equifax. These are likely to be used in all three of score, affordability and lending policy. In affordability, it'll be used for picking up outstanding debt balances and repayments. In lending policy, it would be for building credit history rules, such as missed payments, or adverse credit, such as CCJs and defaults. I'll discuss how it's used in score a little later. Lenders are seeking to automate these elements more and more, partly to improve the customer journey, but also for the associated operational benefits. For example, by automating more parts of the elements of the process, this frees up our underwriting team to add value on cases where their experience and expertise is needed to make these decisions. It's a tough balance to get right. Automation allows the potential for increased lending volumes, more consistent decisions, and faster turnaround times, which are all big wins for both brokers and lenders, I'm sure you can agree. But flexibility allows for more balanced view, where data doesn't necessarily tell the full story. In a perfect credit risk world, you and I would want the data to tell the full story, but currently there are some opportunities to enhance this view with additional evidence of savings, additional sources of income, or future changes to its circumstances. There is a spectrum of new lending processes, from the fully automated decisions right down to the manual underwriting. A fully automated process for all applications is currently very challenging due to the regulatory requirement to verify income. While this can be automated using current account transactional data, which is commonly abbreviated to CATO, this isn't possible for all applicants or sources of income. These more complex cases require manual verification of suitable evidence. But where the income can be evidenced, simple cases may be fully automated throughout the whole journey. But on the converse side, immediate declines may be provided to provide a quick response to say no, which can save time and false hope for brokers and customers. But where flexibility and underwriter expertise could be utilised is for your referral cases. Karen will talk about that a little bit more later on. On to credit scoring. Credit scores can be seen as a little bit of a black box, so I want to share some insight on what they are to help you consider how lenders use indebtedness and credit history to filter out the cases they don't have the risk appetite for. Most lenders have their own internal scorecard. Some have several for different types of lending, such as prime, subprime, residential, buy-to-let, and first-time buyers, for example. Scorecards are built based on known previous data which shows what things could be predictive of future arrears to allow lenders to differentiate between high and low risk. Typical variables to consider for inclusion in a scorecard might be application data, such as your loan to value or your lending segment, or information about the applicant. Credit search data, for example, such as public information, CCJs, level of indebtedness, and credit performance, things like number of missed payments, number of open accounts, number of searches and overdraft usage, they can all come into play. And in a model, it's all about how many of these have you got, and how recent is it. The more recent and the higher value, the more likely you are to be declined. Our scorecard, as is for all lenders, is commercially sensitive, but I've got an example to demonstrate how they work. This particular example is built up of 3 variables: loan to value, number of missed payments in the last 2 years, and credit card utilisation, which is the percentage of a limit. So for example, imagine you had a credit card limit of £10,000 and you had an outstanding balance of £1,000, that would be credit card utilisation of 10%. Also in this example, I've got 3 customers I'm going to put through this dummy scorecard to show you how it works. So I'll talk you through the variables. So loan to value, this has been split into 3 different bandings: 0 to 60, 61 to 85, and 86 to 95%. And they've been allocated points depending on how risky they are in conjunction with the other variables in the scorecard. So in this instance, you get the most points for 0 to 60, and you get the fewest points for 86 to 95, in line with the level of risk. For the number of missed payments variable, it's been split into none, i.e. up to date for the last 2 years, 1 and 2 plus missed payments, again getting the most points for no missed payments. For credit card utilisation, the most points are for the 0 to 25% utilisation, i.e. you're not using your credit card limit very much. So running through the different customers, we've got a low risk, a medium risk and a high risk customer. So the low risk customer has a 55% loan to value, has no missed payments in the last 2 years, and 10% credit utilisation. This person would get 50 points from the loan to value variable, 80 points from the no missed payments, and 100 points from the credit card utilisation. So 50 plus 80 plus 100 equals 230. That's the score for that customer. The second customer has a loan to value of 80%, has missed 1 payment in the last 2 years, and has 50% credit card utilisation. They would get a score of 65 based on 25, 25 and 15 points. Customer 3, the highest risk of the lot, has a loan to value of 90%, has missed 2 or more payments in the last 2 years, and has utilisation of 80%. They would get a score of just 25 points. The way a lender would then use this information is to set a scorecard cutoff for declining cases and potentially want to refer them. So in this example, I've set a scorecard cutoff of 50 points or below to decline them, and between 51 and 75 they would be referred. So in this example, customer 1 gets a score of 230, is comfortably accepted. Customer 2, who has a risk score of 65, they would be referred, and customer 3 would have a score of 25, they would be declined. Obviously, lenders can manage their risk appetite and control the lending they do by adjusting scorecards, among other things. So if, for example, we felt we were taking too much risk, you could increase your scorecard cutoff to, let's say, 80. That would then also decline customer 2, who had a score of 65. One thing that's worth noting is a lender's score is different to their generic score customers can sometimes get on their credit report from Experian, TransUnion or Equifax. So if you had 2 applicants, both with the same Experian score of 800, for example, they may get different decisions from a lender, because each customer is different and lenders will have different scorecards and different methods of deciding who's acceptable. A lender's risk appetite can also impact whether an application is accepted. The risk appetite is the level of risk a lender is prepared to take. For example, only a certain volume of a particular lending type. This can impact accept rates by segment for different lenders. For example, currently lenders may be controlling the volume of high loan-to-value business they offer in the current COVID scenario. They have a number of options to manage this to stay within their risk appetite. For example, adjusting the price of the products they offer, adjusting the scorecard cutoff, as I just gave an example of, changing their lending policy, or making an adjustment to the affordability model. There are various other options as well. But crucially, just because one lender declines an application does not make them poor quality. They just might not meet a lender's appetite for risk in that segment of lending.
Thanks, Aidan. So, scoring is great. It can give you an instant no so that you can place your case elsewhere, and can give you a yes, meaning it's worth putting in your application. Scoring is predicated on the past behavior of similar customer profiles being replicated in the future. So, if highly indebted cases have gone into arrears previously, they are more likely to be penalised by the scorecard. Underwriters will take a similar view on many of the characteristics of the case available to them at underwrite. They will review policy, indebtedness, affordability, and bank account conduct, and a good underwriter will look for positives about a case where it is borderline to support our need to lend responsibly and within the lender's risk appetite. Scorecards cannot necessarily know the new either. COVID impacts are a great example of this. Who would have heard of furlough 12 months ago? Niche segments not previously considered are other examples. A lender new to shared ownership will put together their policy on the basis of risk appetite, and it will be up to the underwriter to check against this policy. Using automation and quick decisioning in tandem with the knowledge of experienced underwriters is the ultimate balancing act for most heads of operations. We want to speed up the process and minimize the touch points for those cases that are good risk, good affordability, and simple. We also want to support good quality, albeit more complex lending types, such as self-employed, multiple income sources, and non-standard family circumstances. Getting this balance right between those that need the extra underwriter consideration and those that can be one touch and day one offers is key. Lenders should have a clear lending policy guide on any other red flags that sit outside of the pure data view that could slow down an offer or lead to a late no. Knowing the lender's policy on items such as the use of payday loans or regularly dipping into overdraft usage, gambling debts, or use of benefits income will reduce the likelihood of your case hitting one of these hurdles. You know your client better than the underwriter. So if you know there's something unusual about the case, be upfront about it, explain the why, and be prepared to provide any evidence to support this. Here are 3 examples of cases that would come through to a lender. On the accept case, it has passed the scorecard, met affordability, possibly even automated income verification, and might not even need a full physical valuation. In these instances, it is possible to automate much of the verification requirements, and there'd be little need or value in utilizing knowledgeable underwriting resource reviewing this application. For the referred case, while it does pass the application scorecard, it doesn't meet the coverage requirements. On the face of it, without any other substantiating evidence, the case could be declined on the basis of coverage. But if you know your client and they put aside a regular monthly amount into savings to cover voids on buy-to-lets, provide this evidence. They may have had a long-term tenant, been uncomfortable raising the rent due to the stability, and have the income level to support this. Know your lender's top slicing policy and include this information with the application. For the decline case, something is beginning to go amiss for this customer. Their income has deteriorated and credit card utilization is increasing. If the scorecard was a fail, then I wouldn't recommend chasing down this case. It isn't within that lender's risk appetite. But if the case initially referred, explain why the income has decreased, provide evidence of additional income where available, or savings to pay off credit cards if this was a one-off purchase. So essentially, know your lender, know your case and your client, and provide that information where you feel this will add value. Here are some tips on placing a case. Know your lender's policy on adverse. Talk to your client not just about defaults or bankruptcy, but about how much of the credit card they're using, whether they've got payday loans, the kind of triggers that can move a case from a yes to a maybe or even a no. Use the tools that lenders provide, lending criteria on their websites, and affordability calculators. Know your lender's policy on documents and additional information required to support your case and allow for the underwriter to make an informed decision. You know when a case is a good one. Only provide what you need to, as underwriters need to review whatever is received. Talk to your client about the estimated value of their house on a remortgage. It is easy to overestimate this, and there's nothing worse than having to re-advise on a product as the LTV just isn't achievable. There are many ways to get in touch with lenders where you need support or you just aren't clear on policy for that particular client. Web chat is a great addition to contact options and can provide a quick steer. Know when to phone BDMs and support teams, as much of the information is available to you, either on credit sourcing systems or lenders' websites. Hopefully, these tools will enable you to place the case successfully. Thank you for listening.